Folks, welcome back. Greg Silverman, CPA from SJ Garowitz Tax and Accounting Solutions. I'd like to talk to you today about a financing mechanism called the ROBS rollover, whereby you can access your retirement savings to fund a business. It's a great and unique structure. Come and join me, see how. Okay, what is ROBS? ROBS, or Rollover as Business Startup, utilizes an existing 401k retirement fund to finance a new or existing business without incurring early withdrawal penalties or income taxes. That's the key point. You don't want to take money from your retirement savings and incur an early withdrawal fee, which in this case is 10%. You want to avoid that, but you still want to access the capital. How do you do it? 4 steps. Form a C corporation. Why does it have to be a C corporation, you ask? It has to be a C Corp because a C Corp can issue what's known as qualified employer securities. That is basically stock that your 401k plan is eligible to purchase. Create a retirement plan. The C Corp will establish a retirement plan. You will roll over existing funds from your existing retirement plan to the new corporate retirement plan, and you will use that money to fund the business, when you plan on purchasing the stock. Well, you set up a new business and then you normally do an asset purchase. That's something we'll go into later. It's the whole SME movement that this structure is. So stage number 4 is therefore to fund your business from the new retirement funding. You buy stock in the C corporation, providing it with capital. So number 4, you use the money then to fund from the retirement plan to buy the C corporation stock, and the purchase is essentially the cash is transferred to the bank account of the company. Because it can then be used to acquire assets in an asset purchase, if you will, or maybe even in a stock purchase, acquire stock of another company. So that's how a ROBS rollover, say a 3 times fast mechanism works. The advantages real quick regarding ROBS versus traditional financing really revolve around the fact that it's equity. It's not debt. So it's debt-free financing, preserves cash flows. There's no need for interest rate concerns. When you don't have interest payments and debt payments, there's a higher chance of survival, so improved business survival. No impact on your personal credit. Again, it's equity, not debt. And you can continue to contribute as before to retirement savings. There's no concerns there. Some of the considerations. The company, it's the 401k that owns the company, the stock in the company. It's possible that you start a business and it goes to zero. I hope that doesn't happen, but it's possible. If that's the case, then your retirement plan will suffer a full loss of that amount, will go to zero. So potential total loss of investment funds. That's why, of course, you don't want to put all your investment funds into a ROBS rollover. Regulatory scrutiny, whilst it's being used extensively now to acquire small and medium-sized businesses, there's always the possibility the IRS, Department of Labor, will look at it differently, alter rules, although they're quite well established, and ROBS providers will provide support. So there you go. There's a lot of complexities and compliance there. So we recommend a ROBS provider that we can refer you to. But it's a great tool, great mechanism if you're looking to acquire a business. Greg Silverman, out.